This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Okay, this is the third lecture on paper F2, basic variance analysis. And remember what we've done. I flexed the budget, we worked out total variances, and we've been going through the cost variances, analysing them. We've done materials, we've done labour, we've done variable. We're now going to look at the fixed overheads. And remember, we talked about this in the first lecture a bit, that fixed overheads we budgeted on at 130,500. And in real life, fixed means fixed, it should stay at 130,500 whether we produce more or less. But because we're using absorption costing, for the profit to be, standard profit to be $7 a unit, it did mean we flexed the fixed overheads. And we stuck in $15 a unit, even though we know it shouldn't really have changed. The actual was 134, and so certainly as against the flex budget, there was a 574 adverse variance. But we still know that this should really have been stayed at 130,500. And so watch what we do. Fixed overheads. We're going to look at two variances, and the first one I think is very obvious and is very logical, the expenditure variance. The expenditure variance, as I've just repeated and I've said several times, fixed overhead should have stayed fixed. And so we need to check, did we spend more or less than we should have done? We compare the actual total expenditure, 134074, with the original budget total. In the original budget, we were budgeting on 130,500. And that really is, whatever else I've said, it should still have stayed at 130. We've overspent by 3574. Whoever the manager is responsible for fixed overheads, I want an explanation of why we overspent. It's nothing to do with producing more. Producing more itself shouldn't have put the cost up. So I think not only is that one easy to remember, but I think that's probably the most obvious variance of all. However, because we did that flexing business, the actual variance, comparing actual with fixed, was I think 574. And so we do need to sort out what's happened there. This variance in some ways is a bit of a cheat, but we call it the volume variance. Why did we put a bigger cost in the flexed budget? It's because we produced more. And in the flex budget, rightly or wrongly, we were putting in every unit produced at the 15 a unit. And so to explain what happened there, if we look at units, the actual production was 8,900. And so if you look back, we charged 8,900 at $15 a unit. The budget production, though, I forgot what it was 8,700 units. And so there should really only be 8,700 units at 15, 130,500. But in our flexing, we ended up putting in 8,900 units worth. So we ended up charging 200 units worth more of overheads than we really should have done. And how much did that mean in dollar terms? Putting in an extra 200 at 50 units, well, at standard cost per unit of 15, it meant we put in 3,000 more than we really should have done. Now, arithmetically, that's not hard. It's not hard to learn. But always, people get upset. Oh, is it favourable? Is it adverse? You see, all the others, we can make silly mistakes, when you're rushing. But all the others are logical. You've either spent more adverse, you've spent less favourable. This one's not quite as obvious. Is it favourable or adverse? Well, the real way of deciding, what's technically happened, is that because we produced more, we've put in more 15s than we should have done. And if the extra $15 weren't there, it would mean lower total cost, it would mean more profit. It is favourable. Now, it's easy for me to say that, and if that's perfectly obvious, fine, no problem. In the middle of an exam, it's not always easy to think that through. The way I remember, which is a bit of a cheat, but it always works, I say to myself, oh, there's been more production. That's good. And because it's good, the variance is favourable. Whereas had we had less production, I'd have said, oh, more production, good, less production, bad. And it would have been adverse. Now, I'd say it's a bit of a cheat, really. More production, less production isn't necessarily good or bad. But that always works for me here. And of course, it does now agree. The total variance was 574 adverse. Now we've made a bit more sense of it. We've actually overspent 3,574 adverse. The other 3,000 favourable was due to that flexing because we're using absorption costing. So there we are. In fact, fixed overheads, to be asked this in F5, to be honest, is extremely unlikely, certainly these days. I said at the beginning that you will never be asked a full paper F2 question like this. At paper F5, extracts from it could be relevant. You could have questions which wanted you to work out the materials variances, just materials, and then do something else. So you do really need to know the rules, but fixed overheads, let me slightly evolve. Also, those of you who've done paper F2 will know at F2 you could be asked to further analyse that volume variance into something called capacity and efficiency. For paper F5, that just is out of the question. It wouldn't happen at F5. I doubt they'd ask fixed overheads at all. If they did, the most they'd want is expenditure volume. So I'm not going to do any more on that. However, although we've now dealt with all the costs, there are two other things that have affected the profit as to why we're not making budget profit. And we effectively did discuss them earlier when I did the flex budget. That remember, when I did the flex budget and looked at the variances, I said management are interested in why the actual profit is different from the original budget. Well, the original budget said 56,000. The most obvious reason why things have turned out different is because we sold more units. If sales go up, that meant we expected more profit. And of course, the other thing that affects us is the selling price. That what we sold should have been at 630. For the same sales, we only got 613,200. We've obviously dropped the selling price, and that's lost us money. Now, okay, we already know the effect of those two from the flex budget. Selling more on its own gave us an extra 2,800 profit. Selling at a lower selling price lost us 16,800. But if you're asked about variances, then you wouldn't have had to do the flex budget. You need to be able to write them straight down. So learn the rules, because in fact, whatever I've kept saying about F5, when they have asked little bits of F2, I think more often than not it's been the sales variances. And it's two completely separate things. First one that affects us is selling more or less, and we call this the sales volume variance. And to calculate the sales volume variance, we compare the actual sales uh, 8,400 units with the budget sales 8,000 units. So we sold 400 units more than we expected. And if everything else went perfectly, if we sold the right price and if all the costs were right, if everything else went perfectly, that would increase the profit by the standard profit per unit. And what is the standard profit per unit? Remember, the standard selling price is 75. The standard total cost is 68. And so every unit should be making $7 profit. And therefore, 400 extra units on its own would have given us 2.8 extra profit. It'd be favourable. I say we already knew that, but again, if you haven't got, since you wouldn't have the flex budget in front of you here, make sure you can work it out straight away. What else affects us in relation to sales? Well, the sales price. If we change the price, if we charge $1 less a unit, then on its own, that means $1 less profit. So to get the effect of a change of sales price, we take our actual sales and we compare what we actually sold them for So we actually sold 8,400, and in total we sold them for 613,200. We compare with what we should have sold them for, actual sales at standard selling price. 8,400. The standard selling price, the budgeted selling price, should have been 75, and therefore the revenue should have been 630,000. And so the revenue is lower by 16,800. And again, if everything else was perfect, drop the selling price $1, the profit goes down $1. It's adverse. The profit would be 16,800 less. Now, some people want to add those two together. I mean, we don't. They're two separate things here. The profit's affected, on the one hand, by selling more units. Completely separately, it's affected by selling at a lower price. So we've now got everything, and let me finish this lecture by producing what we call an operating statement. I said some time ago that what management are really interested in is why the actual profit is different from the original budget. We now know all the reasons. We sold more units, we sold at a lower price, we had all those cost variances. Well, the operating statement is just putting all of those in a neat statement. Again, explaining why actual was different from budget. Now at F5, in fact, you'll never be asked to produce an operating statement, but you are expected to know what it is. And it only takes a couple of minutes. We've done all the workings. So I think we can spare a couple of minutes. I think it's more obvious what it is if you've actually seen it. We start off with the original budget profit. I'll try and avoid winding up and down the screen too much, otherwise it'll make you feel ill. But if you do look back, what was it? We were budgeting on selling 8,000 units. Each unit should have given us $7. We were budgeting on 56,000. Why didn't we make 56,000? Well, the most obvious reason of all was we sold more. We've got the sales volume variance. And we just worked that out a minute ago. The sales volume variance was 2,800 favourable. And so we're now expecting a profit of 58,800. Why didn't we get 58,800? Still on sales, we dropped the price. Sales price variance. Again, we've just calculated, I think it was 16,800, yes. Adverse. So we're now down to a profit of 42,000. Why didn't we get 42? Well, all the cost variances. We've done all the workings. It's simply a question of listing them. And for neatness, standardly, let's list them as favourable, adverse, and then at the end we'll adjust by the total. So let's run down and let's see whether I can remember them. We had materials expenditure variance. You can look back and check, but I think that was, we overspent, it was 3,867 adverse. We had a materials usage variance of I think it was 612 favourable. Labour, we had a rate of pay variance. I can remember that one, it was 2,485 favourable. We had an idle time, I can do that one in my head in fact, it's 6,500 adverse. We had an efficiency variance of 2,000 favourable. So see what I'm doing, I'm just listing, we've done the workings. Variable overheads. We had an expenditure variance, these are both favourable, it was 852 favourable. An efficiency variance, labour was $2,005, favourable $2, 800 favourable. And finally, a fixed overhead variance. Expenditure 3,574. This one I will have to wind back, I'm afraid. Expenditure 3,574 adverse, and volume 3,000 favourable. 3,574 adverse, volume 3,000 favourable. And so what are the totals? The total favourable variances $9,749. The total adverse variances $13,941. I'll soon find out if I do my arithmetic right. So there's a net adverse variance, 13,941 minus 9,749. So 4,192 adverse. And what does that do to the profit? We've got as far as 42,000 minus 4192 is 37,808. Which, if you look back, was the actual profit. So you see what I mean? You know, I said you're not going to be asked to prepare it, but do be aware what it is and why management is so interested. They expected 56, they want to know why we didn't get 56, and there's the explanation. And more than that, they'll want to know why the problems occurred. You know, we overspent on materials. Yeah, we'll expect a report from the relevant manager explaining why we overspent. Is it something we can avoid happening in the future? Or is it something that's going to keep on happening? Say a bit more about that later. All right, unfortunately, or fortunately, depending on which way you look at it, we're not finished yet. Because that question there, if you think back to the very beginning, this company was using absorption costing. The cost per unit included an absorption of fixed overheads at $15. However, as you should be well aware, the alternative for management accountants is to use marginal costing. Well, we don't absorb fixed overheads. And so in the next lecture, I'm going to do this question all over again, assuming that we're using marginal costing. Now, it sounds awful. In fact, as you'll see, there's very little extra work involved, very little. It won't take long at all. We've done most of the work, and I'm not going to repeat it. But it is important you see it. And in fact, in the exam, I've already said it, for the basic variances, it would only be extracts if it's asked. But although it could be absorption or marginal, it's actually more likely in the exam to be marginal. So I promise you it won't take long. I'll say there's not much involved. But next lecture, same question, as though they were doing marginal.